Welcome to another episode of Learning About Loans. I got with me the great and wonderful, amazing Miss Krystal Miles. I know I owe her an apology slash thanks. Uh, she is busy. We are busy. So this is inconvenient. And she's had to move it. We were supposed to do it yesterday. So thank you, Krystal, for being here. And thank you for taking good care of us and all of our wonderful clients.
Of course.
What are we talking about today? What's the topic?
So today I wanted to talk about trusts and trust income and just the importance of one, trying to qualify with that kind of income, but also why it is important to have a trust.
I like it. So in
So,
other words, and by the way, trust doesn't necessarily mean trust fund, right? It doesn't necessarily mean mommy and daddy Warbucks is giving you like $1 million a year in income. A trust is a way to set up something to protect income or to protect assets, things of that nature, to just make sure the next generation. So it's more estate planning. So anybody really could, and I do believe should have a trust. It's a whole separate piece that we'll get on as part of my soapbox later. But Miss Krystal, so obviously I know you and I are working on this. Is actually a great topic. I know we're doing one right now. So
yes.
fill me in. So first of all, let's talk about what. Let's just go real basic for all of like 10 to 15 seconds. What is a trust? Like, what's it take to set up a trust? What do you do, and what do you know?
A trust is something that you can set up through a lawyer, and as you mentioned before, it is about estate planning. So I know a lot of people are very familiar with wills and not as familiar with trusts, but a trust is an extra layer of protection. It's taking your personal liability and putting it into an entity instead. And so, as you move forward in life and things happen, if something were to happen to you, having your property and your assets in a trust basically helps keep the court system and the government out of your personal business.
100%. Ding, ding, ding. A plus plus on that answer, right? So a trust is just a legal thing, that entity that gets set up. You then can put your assets. So Caroline and I do have a trust. And so we put the trust underneath that, like the house, the assets, even our checking account, right? Is it goes towards the trust. So if for some reason, hopefully, but not a long time from now, when we both don't wake up, we don't have to go through the whole probate, the stuff and the courts get involved. It literally, the will says, here's what we do, and everything in the trust, just that it knows where to go. So it's a way to protect your assets, to make the estate planning process better. It can protect your assets and sometimes in legal stuff too, just so you know. But
Mhm.
at the end of the day, that is a trust. Ballpark for asking, I want to say the cost can be the very low side. I would say it's 1,500 to 2 grand, but more than
Mhm.
likely it's probably closer to 4 to 5, coming somewhere in that range is my guess for a revocable trust. And if you don't know what it means, it doesn't matter. Revocable just means you can put stuff in and take stuff out, put stuff in and take some out. So we're going to
Yes.
focus on revocable trust, because irrevocable isn't really from an income standpoint. It doesn't matter. It's the same in terms of how to determine it. But we will focus on trust today and the income somebody can get from it. So, Krystal, why is, you would think it's just automatic? So I got a trust. Here's my $1 million. Do I qualify? What do they need to know? And tell me more about trust income.
So for the most part, in order to use income from a trust, it does have to be established for 12 months so that we can see the consistency of those payments. But there is an exception to that. If you have trust verification documents and you as the borrower are not the guarantor of the trust, and you've received at least one payment, then you can go ahead and use that without a 12-month establishment. And what I mean by the borrower is not a guarantor, a lot of times that is an inherited trust. So, your parents, your grandparents had a trust and it was left to you. And so it's not you and your personal money and you just set up a trust and you all of a sudden you're receiving payments. Because in a situation like that, we would want to see that it's been established for 12 months and that you've received those payments consistently for 12 months. Now, with that being said, there is a difference between fixed payments and variable payments. If you have variable payments, meaning you don't receive the same amount every month, then we do have to average that out over a 24-month period. That way, all in all, it's about showing consistency in this income.
So, in other words, just to restate what I think I heard is, there are two in terms of how we calculate the seasoning or the timeline of it. If it's a new trust because the money came to you in some form or fashion, is probably the easy way to say it, right? Whether it's through a inheritance. What about a divorce? Is that included? So if the money comes to
Um,
you,
that I'm still trying to
okay.
establish. I've actually got an email out to an underwriter to see how that works because that can be a little tricky, but
Right. So that's the gray area. I
part
mean,
two to be
it just
determined.
goes to show that this isn't a black or white industry. You'd like it to be, and it certainly can be at times. But going back to the part about the seasoning, if grandparents pass away and there's a trust to the kids, that money can be used if, let's say, dear old grandma just passed away, 3 months ago, and all of a sudden I'm just now getting the trust income. It's okay. Again, you got to have somebody there to validate the trust, meaning like a financial advisor or somebody like that, whoever controls the trust to some degree and has that administrative piece to
Correct.
say like, look, funds are coming to grandkid in the amount of X dollars per month for the foreseeable future for this many, however many years or time it lasts. That's
Yeah.
okay. If it's going to be a trust that let's say me is Joe Buyer, I can't just create a trust and all of a sudden just start using that income. It used to be that way, by the way. They changed that fairly recently.
Correct.
And recently within the last 2 or 3 years, but that used to be like the old trick in the mortgage business is somebody with a lot of assets, but no income, put in trust, take one payment and just say, hey, we're good. And that's our income. They got wise to that and changed it. So if it's you putting your money in just for the sake of qualifying, that you said, Krystal, I think is 12 months. Is that correct?
Yes. 12
Cool.
months of payments
12
for
months of
fixed
payments.
payment.
And if it's fixed payments, meaning let's say somebody's lucky enough, they got a scratch off lotto, they throw in $1 million into said account. And so they set up a trust for $1 million in every single month for the last 12 months. They've been getting $5,000 a month. Sounds like, Krystal, we can use that $5,000 a month. Is that correct?
Yes, that's
Cool.
correct.
And every month, if it's been $5,000 this month, $2,000 the next, and $3,000, 8, whatever, the numbers vary. That's when they want 24, or did you say
Yeah.
18?
No,
24?
24 months.
Okay, 2-year history, which makes sense because
And
for the mortgage.
it has to be on your tax returns.
Oh, interesting.
For the 24 month, for the variable one, it has to be on your tax returns.
Interesting, which would make sense, I guess, because you would have a tax return due at least in that 2-year time period.
Yes.
Great tip. Now, as far as the income, if it's fixed and same all the way, all the time, every time, that's an easy, that's the number. For if it's the variable, it's a 24-month. Is that the same for all? Well, I guess better question. Can you use this for all different types of programs? Conventional, FHA, VA, USDA, like their guidelines change for each program.
These would be particularly for conventional guidelines, but a lot of times, even FHA, they follow the same type of guidelines. But I don't want to provide incorrect information, but this information is particularly for conventional guidelines.
And what we talked about earlier too is just the example is how it can change. Because back again, and it might have been 2 or 3 years ago, Fannie Mae did require, let's say, the 12-month established trust if it was your own money. I think it was Freddie Mac was how you get cute and you go to Freddie Mac. So both are conventional, both are the mortgage giants, but even they had their own differentiations of what they allowed and didn't allow. And again, we could be taping this and tomorrow, for all we know, something can change. But for
Yes.
the most part, I do agree with you in your assessment. This should be pretty consistent across all the programs. But again, as Krystal mentioned, there could be certain situations like, hey, I just got divorced. Well, then the question is, whose money was it? Because if somebody had a prenup and you're getting the money that wasn't your money, but the prenup, part of the divorce decrees, you get some of that person's money, maybe then it's just set it up. But if it was your money in your account, you earned it and somebody else, didn't work, then maybe it isn't. So again, that's what makes this kind of hard to do these kind of recordings. But at the end of the day, I think what Krystal said is a really good rule of thumb. So from a product standpoint, we think, for the most part, it's going to be pretty consistent. Common sense sometimes plays a part in mortgage world. Income we talked about as far as variable versus fixed, seasoning. What else am I missing? What else do we need to talk about?
That's the gist of it now. I think we definitely need to do part 2 once we find out about certain situations like divorce situations, and then also our other products like FHA, VA, USDA, because they do vary a little bit. And to not convolute things, I definitely think we'll have a part 2 to this.
Love it. So this let's go for today because we know what we're talking about for conventional. And it's not that we don't, but again, things just change so much. And again, with the recent changes we just mentioned, it is nice to know. But I would say I go back to Krystal's point earlier. Most, once Fannie and Freddie kind of set a rule, the industry tries to abide and follow within the same because again, they don't take it lightly. Like if the mortgage giants say yes, everybody's going to fall in, and there might be some overlays. And also take this to note. If you call us and you got a trust or something like that doesn't fit these guidelines, there are a ton of what's called non-QM. So there are a ton of investors, non-qualified mortgage, where they go outside the box And who knows what they allow. It could be, everything we can be saying can be totally wrong and they allow everything. It's just a matter of, we got to figure that out. And it just depends on what somebody wants. We do our best to fit them in the box, the normal Fannie Freddie, because that's usually where you get the best terms for financing. But certainly if somebody doesn't fit in that box, Krystal, you are especially good at finding the ways to get around it and find those investors that'll do the stuff that doesn't in there. So with all that said, if you guys have questions, reach out. Krystal's incredible. She's amazing. We certainly do our best here to make sure you guys know what you're doing and take good care of it. So thank you again for joining us for another
Before we
edition.
let you go, though, I know,
hit me.
Mark, you touched on the revocable versus the
Oh,
irrevocable.
yes, I did forget about that. I should have asked for closing statements. Thank you. Hit me on that one.
So the biggest difference is if you're wanting to close in one entity versus the other. Most products will only allow you to close in a revocable trust. But if you already have a trust established, you can absolutely close your loan in that trust instead of in your personal name.
Can you close in an irrevocable trust? I don't think you can.
No, it has to be a revocable trust.
Right. So again, guys, the reason why is when you put it in irrevocable, meaning you can't change it. Like, you are giving up essentially ownership. It's a tax. I know enough about this to be dangerous, but it's a tax thing to say, I don't own these assets, or control. And I think the key word is control. I don't control those assets anymore. So that's why we as lenders don't want you putting your home that we're lending into something that you can't control or get out. So that's why it has to be revocable, so that you can put the asset, being the house in this case, in and out, in and out, in and out. So go back to you'd like people closing in revocable trust, Krystal. Is that true?
Yes. And we can also do that as part of the closing. So if you don't have a trust and you want to establish one and close in it as part of the transaction, we can actually do that during the process.
And I agree with Krystal. I highly recommend doing it. Yes, it's going to cost you an extra $3 or $4 grand, but at the end of the day, the house won't be the only thing you use it for. You can start using that trust for anything and everything you start doing. Now, again, Krystal, does that matter? I don't think. I'm 99% sure I know this. Can they have like just one big master trust? You can have the house in there and we can still do what we need to do from a mortgage standpoint, correct? It doesn't matter if they have their, okay. So yeah, you guys can put other stuff. So if you don't have one, get one. Yes, it's expensive. I know $3, $4 grand is not chump change, but at the end of the day, we got some really good attorneys. I got 2 or 3, depending on where you are and what you want to do. Some are nationwide, some are here local in Texas. So reach out to us if you need that help. We'll certainly get it to you, Chris. Thank you for bringing that up, because I mentioned that earlier and I forgot to bring it back. Anything else before I forget?
Nope, we're all good.
All right, now's the official sign off. Thank you as always for joining us. We'll see you on the next episode.
Thank you.
Bye, everybody.